Ladies and gentlemen, welcome to the SUERF-Banca Italia workshop on the effectiveness of monetary policy in a low interest rate environment. Let me first of all warmly thank the members of the scientific committee, Jacob De Haan, Giuseppe Grande, Mario Petrunchi, Stefano Siviero, and Frank Smets, and of course Banca Italia. We start out with Daniele Franco, Senior Deputy Governor of the Banca Italia, giving us his welcome address. With this, Daniele, I hand over to you.
Thank you, Ernest. I'm very happy to welcome you all to the Banca Italia and SUERF joint workshop on the workshop addresses issues that are now at the top of the policymakers' agenda around the world. The pandemic has led to the worst recession in recent history, and the scars that it will leave on the global economy are likely to prolong the low interest rate environment. Monetary policy is playing a key role in supporting the recovery, and its contribution will remain fundamental in the coming years. The discussion of strategy, targets, and tools remains open. Today and tomorrow, we will have the opportunity to embark on a wide-ranging debate on the challenges ahead. In my remarks today, I will touch upon a few of them. To begin with, I think we can all agree that the pandemic crisis has further exacerbated the effects of some ongoing long-term trends. Some of these trends have already been in place since the great financial crisis and its aftermath. I'm mostly referring to the drop in the natural rate of interest and to the subdued inflation dynamics. These trends are due to structural changes in macroeconomic relationships and imply a need both to reassess theoretical framework and to review the monetary policy strategy and tools. In this respect, the first session deals with monetary policy strategy in such a low interest rate environment. This, of course, calls into question the issue of the appropriateness of the current inflation target, which is indeed one of the main items on the table in the Eurosystem monetary policy strategy review. I will not comment further on the strategy review since it is still ongoing. Another important theme in the post-pandemic environment will be the interaction between fiscal and monetary policy. As we know, fiscal policy worldwide was boldly expansionary during the most acute phase of the pandemic crisis. In the European Union, an unprecedented joint response of member states will contribute significantly to the recovery in the years to come. In the current circumstances, a sizable fiscal stimulus is necessary in order to sustain aggregate demand. However, that very same stimulus raises new challenges, as it will result in a record increase in public debt around the globe. Although I firmly dismiss the risk of fiscal dominance, nevertheless, monetary policy cannot ignore the impact of fiscal policy, as is made clear by the second paper of the session. These considerations take me to tomorrow's third session, which will focus on structural changes in monetary policy transmission. Indeed, the historically high levels of public and private debt may well have an impact on the transmission of monetary policy through channels such as the interest rate exposure, which in the current environment may lead to significant wealth and income effects. One can argue that high levels of debt boost the monetary policy transmission mechanism via leverage effect, but at the same time generate the risk of higher volatility and ultimately may have financial stability implications. The repayment of this high debt burden is currently being made easier by the low nominal interest rates regime, an aspect emphasized by Olivier Blanchard in his American Economic Association presidential lecture last year. However, the persistent low, medium, and long-term interest rates cannot be taken for granted. Moreover, episodes of financial turmoil due to market perception or to a change in fundamentals can happen, creating a negative feedback loop between market expectation and macroeconomic fundamentals. This allows me to touch upon the topic of the instruments of monetary policy, which will be the focus of the concluding session of the workshop. The unconventional policies adopted by central banks around the world in the last decade have proved effective, as a copious amount of evidence suggests. The evidence gained with the new monetary policy tools in the last decade must guide our choice of the unconventional instrument the central bank should retain in the toolbox. Undoubtedly, many of the instruments deployed in recent years will remain in use in the near future. At the same time, we are now better equipped than in the past to mitigate the undesired side effect of some instruments, as in the case of the two-tier mechanism for the remuneration of excess reserves. A final point that I would like to touch upon concerns the governance of economic research at the present time. Economic research is part of the monetary policy toolbox. Sound economic research is a precondition for the independent assessment of the most appropriate monetary policy stance. As Governor Visco remarked, monetary policy cannot wait until sufficient information accumulates that may cast full light on the new mechanism at work. This issue has been evident in recent years, when we all face the great challenge of conducting both policy and research in real time, as the former ECB President Draghi once said. Precisely because of that, timely and high-quality economic research has become increasingly important within central banks, since there is a compelling need to assess the impact of new policies as they are deployed. In this respect, I see two main challenges for central banks in the coming years. First, in the face of the great uncertainties on the shape, timing, and features of the recovery ahead, we must keep producing research in real time, making use of a broad range of modeling tools and of more sophisticated data sets. Second, our research should not only be timely, but should also seek the highest quality standards. Quality is needed to make policy credible for both experts and the general public alike. Clarity in communicating our results is also crucial. At the same time, the complexities of the current economic environment urge us to keep enlarging the range of research topics covered in order to better understand the drivers of the structural changes affecting the real economy as well as financial markets. In light of the above, it is of the utmost importance to strengthen international collaboration with other central banks, universities, think tanks, and industrial bodies in order to generate and nurture new and better ideas. We are delighted that this workshop has been co-organized by Banca Italia together with SUERF. Through a wide range of events and publications bridging research and policy, SUERF is an outstanding meeting point for the profession to foster a fruitful dialogue between central banks, financial sector practitioners, and academic institutions. We can now start delving into the core topics of our research workshop. We do so with one of the most prominent and renowned researchers in macroeconomic theory, monetary economics, and monetary policy. I'm delighted to introduce our keynote speaker, Professor Jordi Galí, professor at Universitat Pompeu Fabra and at the Barcelona Graduate School of Economics, director of the Center for Research in International Economics, and a research fellow or research associate at the CPR, NBR, Econometric Society, and European Economic Association. He's very well known in the central banking community for his groundbreaking contributions to dynamic macroeconomic models, the determinants of inflation, and the conduct of monetary policy. We are looking forward to his insights. Jordi, the floor is yours.
Well, thank you very much for your kind introduction, and thank you very much to SUERF and Banca Italia for inviting me to participate in this event, which looks very interesting and stimulating. Let me start by saying that my presentation will be based on work in progress with Philippe Andrade, Hervé Lévigan, and Julien Materon. And my co-authors are at the Federal Reserve Bank of Boston and the Banque de France, so the usual disclaimer applies. So the motivation for this project, in which, as you can see from the title, we aim at answering the question as to whether the ECB should adjust its strategy in the face of a lower R star. The motivation for this work comes from the observation that R star, the long-run equilibrium real interest rate, or the neutral interest rate if you want, has experienced a substantial decline according to a variety of estimates. And also the reasons why R star has declined make us think that decline may be, or is likely to be, permanent or highly persistent, since those reasons are mostly structural, that have to do with aging of the population, lower productivity growth, increased uncertainty associated with technological change that raises precautionary savings, and so on and so forth. Okay, so even though the decline in R star has not been a consequence, or has not been caused by monetary policy, it has potentially very important implications for monetary policy. The most obvious one is that if the central bank leaves its strategy unchanged in the face of this decline in R star, the incidence of the effective lower bound, okay, the lower bound on the policy rate, okay, will be higher. The reason is simple. The average nominal interest rate will be lower, and hence there will be less monetary policy space to respond to adverse shocks before that policy rate hits the effective lower bound, whatever that effective lower bound is. And of course, the implication of this is that the central bank will find it harder to stabilize inflation and output in that case, and the economy will underperform relative to a situation in which there was no such effective lower bound. Now, so the question that we ask ourselves is whether the monetary policy strategy should be adjusted in the face of a lower star. And what do we mean by the monetary policy strategy? We think of the monetary policy strategy as having two elements. One is the inflation target, and the other element is the rule that the central bank follows in order to achieve that inflation target. Okay, so we can decompose our question, if you want, in two. We can ask ourselves whether the inflation target should be raised given an unchanged policy rule, or whether the policy rule should be modified while keeping the inflation target unchanged. Of course, there's always the possibility of changing both inflation target and the policy rule. So what we do in this paper is to provide a quantitative analysis of that question based on an estimated model, a Keynesian model, for the euro area economy. Okay, and this is a follow-up on some earlier work of ours, which was based on a model estimated using US data, and which just came out recently in Brookings papers. Very good. So let me preview some of the main findings before I describe them in some detail, and I describe the model as well and the approach. So our main finding is that for the euro area, where, as you all know, the current inflation target is close to but below, but close to 2%, this target is suboptimal if we believe our star is somewhat less than 2%. Okay. And all current estimates of our star, I should say, are well below 2%. Okay, so we conclude that some things must change, either no, there should be an adjustment of the inflation target or an adjustment of the rule, as we'll see. Now, if we keep the rule unchanged, that is, if the ECB were to follow the same rule that it has followed historically, our estimates imply that a 1% decrease in R star, which I view it as a conservative assessment of the actual decrease that R star has experienced, a 1% decrease in R star would call for a 0.9% increase in the inflation target. Okay. Now, our estimates imply that before the decline in R star, that is in the early part of the sample, if you want, or historically, R star, the optimal inflation target was 1.7%, which happens to be below but close to 2%. So a decrease in R star of 1 percentage point would call for an increase in the inflation target. Yes, from that 1.7% to 2.6%. So that would be the modified or the new optimal inflation target. Now, we stress that there are alternatives to raising the inflation target. Okay, and we go over several of those. Let me mention two here. So, in particular, if we build in the policy arrangement a sufficiently aggressive counter-cyclical fiscal policy, then it would be possible to preserve the current inflation target of close to 2%. And I'll tell you more precisely what is an example of that aggressive counter-cyclical fiscal policy in a quantitative sense. And secondly, another alternative would be to modify the rule that has been followed historically by the ECB to incorporate a sufficiently strong makeup component. And there are, as you know, there are alternative ways of doing that. Okay. There is a relatively long literature. There is a little industry, if you want, that has aimed at determining quantitatively what the optimal inflation target is. Here you have a list of papers, a complete list of papers. Now, traditionally, this analysis of optimal inflation was conducted using models that ignore the existence of an effective lower bound. More recently, as you see in the second bullet point, there are a number of papers that have explicitly introduced that zero lower bound or effective lower bound constraint in analysis. Okay, and of course, this is a very relevant constraint for the analysis. Now, what's our contribution or the main novelty of our approach in the context of this literature? Well, the fact that we provide an explicit analysis of the relation between R star and pi star, that is between the neutral interest rate and the optimal inflation target. And of course, like many of the papers that you see listed on the slides, there is an important caveat that this analysis has, which is that it's an analysis within the model, and I don't think there are clear alternatives to that. That means that we take the model seriously and literally, and we conduct an analysis of optimal inflation. Again, viewing the model as a good description of reality, including the assumptions that are needed in order to conduct a welfare-based analysis of optimal inflation. Okay. Now this is a short presentation, and so I'm sure that many people in the audience are familiar with this class of models. So let me not go into the details of the model. Let me just list in the form of bullet points some of the key ingredients. So it's a medium-scale New Keynesian model, not too different from the new area-wide model that the ECB has used for many purposes. We allow for non-zero trend inflation. the model allows for both price and nominal wage stickiness a la Calvo. We also allow for imperfect indexation of prices to like the inflation, and imperfect indexation of wages to both like price inflation and productivity, trend productivity. As is usually the case in this kind of models, there are many shocks. In particular, we have shocks to the risk premium, the marginal utility of consumption, technology shocks, exogenous monetary policy shocks, as well as shocks to the desired wage and price markups. Okay. Now, in the model, R star is a well-defined object. It's a steady state, or the real interest rate along a balanced growth path, given that we allow for technical progress and thus trend growth. So R star is the real interest rate along that balanced growth path. And it happens to be equal to the sum of two parameters. One is rho, the discount rate of a representative household, and a mu z that is the growth rate of technology, measures technical progress, which is taken to be exogenous. So in our simulations, we are going to change R star, and of course there are two possible sources of those changes in R star, so we will consider them separately. Even though, let me anticipate that whatever the source is doesn't make much difference for our purposes, right? At least in terms of the conclusions that we will draw, at least for the relevant range of parameter values. So it doesn't matter whether changes in R star come from changes in rho or changes in mu z. Now, of course, the policy rule is important in the analysis. That's what much of our simulations will play with. So we start with what we call the baseline rule. And the baseline rule, it takes this form. So it has, so what you see below is a rule that describes the evolution of the policy rate as a function of its lag and as a function of the gap between inflation and some constant pi, which is what we're going to call the inflation target, okay? As well as variable xt, which represents the output gap. And in addition, we have an exogenous monetary policy shock, okay? Now, this is what we call the shadow policy rate because it evolves over time without any constraint, okay? Any lower bound, okay? So it may be negative and it may be persistently negative. However, the actual policy rate, which is IT, is going to be the maximum of this shadow or notional policy rate and the effective lower bound E. Okay, so to the extent that the shadow rate is above the effective lower bound, the policy rate will be equal to the shadow rate. But if the shadow rate is below the effective lower bound, then the policy rate will be equal to the effective lower bound. Okay. Now notice that this rule, the shadow rate rule, implies that the shadow rate, given the presence of this lag term here, the shadow rate may become at a value below the effective lower bound persistently if the economy has experienced a large decline or a shortfall of inflation from target or a large negative output gap, okay, even if the economy has returned to normal, okay, again, because of the presence of this inertia, okay? So that means that the actual policy rate may be at the effective lower bound for a while, okay, even if the economy has returned to normal. Okay, so that's a way, a relatively parsimonious way to model so-called lower for longer policies, in which the central bank commits to keeping the policy rate at the effective lower bound, even after the economy has returned to levels of inflation and output that are close to normal. Okay. Very good. Okay, let me skip the slide. This describes just how we solve the model. And again, let me just mention in terms of calibration and estimation, without getting into technical details, that while we calibrate some parameters, including the degree of decreasing returns to labor and the parameters that determine the steady state markups, wage markups and price markups, as well, and this is more particularly relevant for the euro case, the effective lower bound. So we take the effective lower bound to be equal to minus 0.5% divided by 4, because our model is quarterly. Okay, so what matters is the quarterly interest rate, if you will. Okay, but this corresponds to the current interest rate on the deposit facility at the ECB, which we take to be at least the current effective lower bound. Now, the remaining parameters are estimated using Bayesian methods, using the sample period, the 1985-2014, which corresponds to the period before, according to one interpretation at least, the period before the effective lower bound was binding. Okay. So the model that allows us to estimate the model without the zero lower bound. Well, we impose priors for a number of parameters, for all parameters, but in particular for these three parameters, the discount rate, the rate of technical progress, and the inflation target, that have means that are consistent with the averages that we have observed over the sample period, the averages of inflation, GDP growth, and the real rate. Okay, notice that these three variables have a clear counterpart in those three parameters. And we estimate the model, again, using euro area data, on GDP, the GDP deflator, wage inflation, and the short-term interest rate. Okay, and let me just show you some properties of the estimated model, okay, that will give us some straightforward intuition for some of the results that I'll show you in a second. Suppose that the inflation target, okay, that is that parameter, well, here I'm using pi star, but in the rule it was pi, just the parameter pi, is 2% in annualized terms. Okay, so that's just a, it's not the estimated parameter, but it's close to, okay, and corresponds to the target of the ECB, roughly. Okay, so under that assumption, this is what you see here is the probability of hitting the effective lower bound as a function of R star. Okay, so so this is the fraction of time that the economy would be at the effective lower bound if the ECB followed the baseline estimated policy rule, that is the rule that it has followed historically, as a function of R star. Okay. And you can see that for values of R star around 1% annualized or less, and much of the current estimates fall within that area, you know, the incidence of the effective lower bound, if the inflation target is kept at 2%, is pretty high. Okay, it's close to 15%, or it can get even higher. Okay. Here you see the probability of hitting the effective lower bound. Now, if R star is kept constant at 1%, and we change the inflation target. Okay. So again, if the inflation target is 2%, the current one, we see that the probability of hitting the effective lower bound is above 15%, a very high value. Okay, so it would take an increase in the inflation target to lower in a significant way that probability. Okay, again, these are just some of the basic properties of the model to get some intuition for the results that follow, that you know, focus, as I said earlier, on computing the optimal inflation target. Okay, and by the optimal inflation target is the target that maximizes expected utility of the representative household in our economy. Okay, so we in order to determine that optimal inflation target, we derive a second-order approximation to household expected utility, call it W pi theta. Theta is a vector containing all parameters of the model, okay? And pi is the inflation target, okay? So, and that will that determines the household expected utility as implied by the model, okay? Now, we define the optimal inflation target pi star theta, that is for a given vector of model parameters, as the value of pi, the value of the inflation target that maximizes this expected utility. Okay, and the way we obtain this is by simulating numerically this economy, allowing for different inflation targets, different values for the inflation target. Okay, and with theta, the vector of the remaining parameters taken to be the mean of the posterior distribution of our parameter estimates. Okay. So the main focus of our results is the R star pi star relationship. That is, what is the optimal inflation target for each possible value of R star when changes in R star are the result of changes in productivity growth or changes in the discount rate. Okay, keeping all other parameters at their posterior. So let me show you. This is, I guess, the central figure in our results. So what you see here on the horizontal axis is the R star, okay, annualized, that we change ourselves, and on the vertical axis, the optimal inflation target that corresponds to each possible R star. And the blue line, changes in R star are the result of changes in productivity growth, whereas the red line describes the changes in the optimal inflation target resulting from changes in R star that are caused by changes in the discount rate. Now, this dashed line for this vertical dashed line corresponds to the estimated R star for the historical sample period, okay, which is 2.6%. So given that historical value of R star, our model implies that the optimal inflation target, as you can see, is 1.7%, okay, which is close to the 2% that's set by the ECB, okay. But as I said earlier, most economists, and I would include here most ECB economists as well, probably think that the current value of R star is well below this historical value. Okay, in fact, it's probably closer to 1% or less than 1%, as some recent estimates in the literature for the euro area suggest. Okay, so if that's the case, notice that our analysis implies that the optimal inflation target should be well above 2%. Okay, so the current specification of the target as below but close to 2%, it seems clearly suboptimal if we believe that the R star is 1% or less. Okay, very good. So now we can ask ourselves, and this is what the rest of my talk will focus on, what are the alternatives? Okay, so one possibility is to raise our pi star, to raise the inflation target, okay, to a value closer to the implied optimal inflation target, okay. But there may be alternatives. So let's look at alternatives. The alternatives involve some changes in the policy arrangement. So the first alternative strategy that we analyze is the introduction or the introduction of a systematic, very aggressive counter-cyclical fiscal policy. And that fiscal policy consists of the following, what we call the emergency fiscal package. If the output gap declines by more than, it's an increase in G, in government purchases, of 4% of output, okay, of trend output, okay, whenever the output gap shows a cumulative decrease of 6%. Okay, so whenever there is a significant recession, I guess. In that case, automatically there is an expansionary fiscal package that consists of an increase in government purchases of 4% of GDP, with a persistence given by this autoregressive parameter 0.85. Okay, so it's quite persistent over time. Okay, so let's see what is the implied optimal inflation target in that case as a function of R star. So the blue line is the baseline, and here I'm restricting myself to changes in R star resulting from productivity growth from now on, just to keep things simple. As you saw from the previous graph, it makes, for values of R star in the relevant range, it makes little difference whether changes in R star are the result of a change in productivity growth or changes in the discount rate. So the blue line is the line that we had seen earlier. Okay, so it's the baseline line that corresponds to the one that corresponds to the baseline policy rule without counter-cyclical fiscal policy. And the red line is the one in which we have introduced this systematic aggressive counter-cyclical fiscal policy. So you can see now that of course, the shift to the left makes it possible to preserve an inflation target of close to 2% as an optimal target for even if there has been a decline in R star. So now notice, let's take 1% as a benchmark value for the new R star. Okay, you can see that now for this 1% R star, a value close to or even slightly below 2% is the optimal. Okay, so that would be one way that our framework suggests that would make it render the current inflation target of the ECB still optimal. Let's see what happens if we let the effective lower bound to go down up to minus 0.8. There is a typo here that should be minus 0.8. Minus 0.5 is our baseline value. Okay, so here's what would happen. We go from the blue line, which is the baseline, to the turquoise line, and as you can see, there is little change. Okay, there's not much of a shift, suggesting that this decrease in the effective lower bound, and we really think that the ECB would hardly consider going below minus 80 basis points. Okay, so this is, we think of this as the truly effective, the lowest effective lower bound that one would reasonably think. So it's not enough to preserve the 2% inflation target as an optimal inflation target if R star is around 1%. Okay, so that doesn't seem to work much. How about increasing the inertia coefficient in the rule? Okay, so this our baseline was 0.87. This was estimated. What if the ECB increased it to 0.95? What does this mean? Well, this means more aggressive, lower for longer policies, as described by this, reflected in this coefficient. And here we see a huge difference. Again, focus on these two lines here, where you see that it shifts to the left quite a bit. And again, it is possible, if R star is around 1%, to keep an optimal inflation target, or to have an optimal inflation target that is below 2%. Okay, so that's but again, this is a very aggressive policy, lower for longer policy. Here's an example of a rule, an alternative rule that would be a substantial departure from the current approach. It's a price level targeting rule, which now it's the same rule for the shadow rate, but now the ECB, instead of responding to deviations from an inflation target, it responds to deviations from a price level target. And that price level target is increasing at a rate given by pi, where pi is the inflation target that we need to decide. Okay, so what is the optimal inflation target if the ECB were to follow this price level targeting rule? And here the change is dramatic. You can see that for values again around 1% for R star, the optimal inflation target would be close to zero. It would be positive, okay, but between 0 and 0.5%. Okay, so in that case, it would be possible to lower the inflation target substantially. Okay, of course, price level targeting rule has been criticized for hinging critically on anticipation effects, and also hinging critically on its credibility, which may be questionable given the strong time inconsistency that it may generate. Here is a milder form of price level targeting that is being discussed these days, and in fact the Federal Reserve has adopted a version of it. It's average inflation targeting. So the idea is that, again, we have the same type of rule for the shadow rate, but now the central bank responds to the deviation of average inflation, not current inflation, but average inflation over a certain past horizon from the inflation target. Okay, and this is the definition of average inflation. It's just the simple average of inflation over the past H quarter. So we consider two possible horizons for inflation targeting: 16 quarters and 32 quarters. That is 4 years and 8 years. And you can see here again, if we move the blue is the baseline. Okay, and the red now corresponds to an average inflation target with a 4-year memory, and the turquoise to an average inflation target with an 8-year memory. You can see that with an 8-year memory, again, even for values of R star around 1%, 2% would still be optimal. Okay. So again, these are the main results. It's still preliminary. This is, as I said, it's work in progress. Okay, so let me just summarize and conclude. So the purpose of this work is to provide a quantitative assessment of the optimal inflation target as a function of R star and under an effective lower bound constraint. And under the baseline estimated policy rule, a decline in R star calls for a close to 1-for-1 increase in the inflation target. Okay. That suggests that marginal costs of inflation are low compared to the stabilization benefits of a higher nominal rate. Now, if R star has declined significantly, as most economists believe it has, and the rule is unchanged, it is clear that the current target of below but close to 2% is suboptimal in the euro area. Okay, so our analysis suggests that this target should be raised, or alternatively, it should be, if it's preserved, monetary policy should be complemented by a more aggressive counter-cyclical fiscal policy, more aggressive lower for longer forward guidance, or the adoption of average inflation target.
Thank you very much, Jordi. Really an interesting presentation, which sort of echoes very much, I think, what policymakers are really carrying on their minds when they discuss the optimality of inflation targets or inflation aims or whatever they are called in different central banks. If I may paraphrase your results, I think your analysis shows that a fall in R star and the resulting loss in monetary policy effectiveness can be addressed in quite different forms: a rise in inflation targeting, an emergency fiscal package, alternative inertia coefficients / forward guidance, make-up strategies, and a thing that you mentioned but didn't emphasize very much, lowering the effective lower bound. You indicated that minus 0.8 might be really the lower bound, but of course we're currently also discussing very actively the future introduction of CBDC, not necessarily the abolition of physical cash, but some economists have argued for this in the past. So this would, of course, be a way of lowering the effective lower bound. So this would be one first question of mine. What do you think about this option? But I have two further questions. Given that R star estimations are really very uncertain, and you indicated this yourself, and also the desired threshold probability of hitting the effective lower bound is, of course, up to discussion. What would be your personal take on the optimal inflation target for major central banks like the Fed or like the ECB? And then another question would be, raising the inflation target at a time of consistent and substantial undershooting of the target for many years, would such a hike in the inflation target actually be credible? And my final question is, what if the effective lower bound is actually not binding because central banks have learned to use non-conventional monetary policy instruments such as QE to extend their policy scope?
Okay, well, thanks for your questions. Let me try to answer them. The first two are somewhat related. Well, on my take on this, well, look, when the ECB designed its strategy, it didn't sow in a vacuum. No, it relied on some studies and some analysis of among other things, what the desirable inflation target should be. I'm not going to say necessarily the optimal. And those analyses were conducted in an environment in which R star, which entered explicitly in those analyses, because some of those analyses are collected in a volume called Background Studies that was published during the Monetary Policy Review of 2003. The benchmark value of R star that was used in those analyses was 2%, and it was presented as a conservative value in the sense that it was viewed as a lower bound to what R star probably was. And on the basis of those analyses and all kinds of considerations that had to do with downward nominal wage rigidities that are not part of our model, the possibility, the risk of inflation differentials between the euro area, and other considerations, it was concluded that a target of below but close to 2% after the review in 2003 was desirable for the euro area. Now, one of the key assumptions behind those analyses now has changed. At least most of us perceive that it has changed, that may have changed permanently. And it's this element, this ingredient, which is R star, our estimate of R star. So I think that in itself calls for a change. Now, it doesn't have to be a change in the inflation target, but it calls for a change. Now, the kind of so I have looked at alternative possibilities. Now, of course, fiscal policy, more aggressive fiscal policy, that's outside the control of the ECB, so let's put that aside because it doesn't depend on the ECB. An average inflation targeting, or some form of average inflation targeting, I think would work in the right direction, in the sense that it would tend to stabilize the economy, but it hinges a lot on credibility and on these anticipation effects really working in practice, and that's questionable. At least it's not obvious. There's a lot of uncertainty about that. Okay. So on the other hand, an increase in pi star and pursuing just a conventional flexible inflation targeting policy around the higher value of the inflation target, that doesn't hinge on this additional credibility or this anticipation effect. So in a sense, it's a bit of a safer route. Okay. So my suggestion would be to pursue both simultaneously. However, as you said in your second question, I would postpone, okay, the increase in the inflation target. But I would announce now that when the ECB hits its current inflation target of 2% or close to 2%, then it will open the door to a reconsideration of what the inflation target should be in light of all the evidence existing at that time. Okay. Now, this very anticipation should help, if anything, at raising inflation expectations. So that would not hurt. Now, when the time comes, I think the inflation and a new target is considered desirable, I think that new target should be implemented only when actual inflation becomes close to the new target. Okay, again, to avoid this possible loss of credibility that would arise if a higher target for inflation is announced when the ECB is currently undershooting its current target. No? So I would do it in this sequential way, whereas average inflation target could be implemented in a sense overnight. The Federal Reserve has done that. It doesn't require any major preparation. Now, regarding the alternative monetary policy, well, our analysis, I mean, in a sense, this rule that we assume, our baseline rule that allows for lower for longer policies, that incorporates at least forward guidance that the ECB has been using to some greater or lesser extent. Our analysis doesn't allow for QE, that's true. Because our model, it's not a model in which you can incorporate easily QE, at least without introducing some kind of financial frictions. However, my sense is that QE, even though it has helped, it has also shown its limits. I mean, the estimates of the impact of QE has worked mostly by reducing term premia and risk premia in some markets. But the quantitative effect of that impact on the basis of some of the studies that I have seen is somewhat limited. Okay, so I wouldn't rely exclusively on QE to get around the constraints imposed by the effective lower bound. As regards to CBDC and the possibility, take it of lowering the fact that introducing digital currency, central bank digital currency, would make room for lowering the policy rate below the current effective lower bound. I think, well, that's true in theory, but I think that would be a risky path to take. I'm all for digital currency, and especially central bank digital currency, for reasons other than this one specifically. I think taking that path would be a bit risky in terms of alternatives coming up from the private sector and the risk of a flight out of currency that would be a dangerous experiment. Let me put it this way. I cannot hear you. I cannot hear you.
I have one question here from the audience, which I will read out for you. Concerning the case of aggressive countercyclical fiscal policy, so your emergency fiscal facility, do you have any hint on whether issues of public debt sustainability might arise and how they could be handled in your model?
Yes, well, they could certainly arise in practice. In our model, this is not an issue because we have a fiscal policy rule that guarantees that the debt ratio reverts back to some constant value after that, but very gradually. Okay. Now that's easy again to write down as a rule. We know that in practice, governments find it particularly hard to engage in a consolidation, even if it's very gradual, to revert or to offset the impact of the aggressive fiscal policy in the case of during the recession. Okay, so again, I think fiscal policy is powerful. I think it should be used. And we somehow should have a framework that allows for such an aggressive fiscal policy during recessions, which is not what was done during the financial crisis, which major fiscal consolidations were underway in the midst of a very severe recession in many countries. Okay, so that clearly we should not go back to that very clearly. But this flexibility in conducting very aggressive counter-cyclical fiscal policies in recession somehow should be complemented by a framework that guarantees that once the recession is over, fiscal parameters will revert back to normal, even if gradually. That's easy to say.
Of course. Building on this, what is your view? Is NGEU, so the new EU fund, is that a game changer for monetary policy? Does it take away some burden from monetary policy in fighting recessions alone, as was the case in the GFC, but is not the case now?
Well, again, it depends on the continuity and the character that this fund takes. As far as I know, I mean, from what I have read, this fund will be available for specific purposes and at a time when hopefully our economies will be out of the current recession. So it is not completely obvious to me from the point of view of stabilization purposes, not for, it may be desirable from other points of view that have to do with long run growth, increases in productivity and so on. But from the point of view of stabilization purposes, I have to say I don't quite understand its logic. But
I don't see any further questions. Jordi, I would like to thank you very much for your lecture. And I wish you all the best. And let's see what the ECB in the end will come up with.
Okay, thank you. Thank you very much.